afternoon now. Welcome to course number 3966, Main Street Cares, Understanding Loans, Forgiveness, and Tax Benefits. Today's presentation is brought to you by the Business Law section of the Florida Bar. This presentation will be part of our COVID series that began on April 30th and continues to grow. The live presentations of the CLEs in this series will be free to all registrants, and we encourage you to register for all of the upcoming events. All presentations in this series are also available for aftermarket viewing at no cost on our section website. Information on each of the upcoming COVID CLEs is also available on our Business Law section website. We also invite you to visit the website's COVID-19 resource page, which continues to be updated with the most recent information available. Please don't hesitate to contact me with any questions on these CLEs or any other resources for the Business Law section. So this presentation is 1 hour, and we ask that all questions be sent via the question and answer box that is at the bottom of your page. It will pop up if you run your mouse over that. The presentation will be moderated by Richard Montes de Oca. And now, Richard, I'd like to go ahead and turn it over to you. Thank you.
Great, thank you, Stephanie, and thank you, participants, for joining this wonderful program. We're looking forward to sharing our insights and some of the information on the CARES Act with you today and our panelists. I want to go ahead and introduce myself. My name is Richard Montes de Oca. I'm the managing partner of MDO Partners. We're a boutique law firm that focuses on corporate and compliance. Prior to starting my firm, I was the assistant general counsel for Royal Caribbean, where I headed up corporate governance, securities, and finance. With me is also Gladys Reed. She's a senior vice president of banking over at Ocean Bank being one of the largest independent banks and community banks in the state of Florida. Very happy to have her, as she is leading the forefront of the Paycheck Protection Program for the bank. We also have Jose Sariego, who's a partner in the corporate department of Bills and Sundberg. Jose also has worked previously as general counsel of Mastech and also in-house as head of business affairs for HBO Latin America and Telemundo. And last but not least, we have Josh Schultz. Josh Schultz is the president of Schultz CPA up in Jacksonville, Florida, with a lot of experience in accounting, forensics, and investigations. He's also been at the forefront of working on several matters related to the CARES Act. And prior to that, he was with Big Four firms as well as Citizens and Royal Caribbean. So that's the introduction to our panel, and we're looking forward to launching this and discussing many of the issues related to the CARES Act. Let me give you a little bit of an overview on this next slide. So what we're about to embark on is basically unprecedented in the sense that what we've seen in much of the society today has been the pandemic of coronavirus. With that has been the stimulus packages that have been afforded by the US government of about $1 trillion, much of which has been dedicated to small and mid-sized businesses, primarily through the CARES Act, and that's what we'll be covering today, the Paycheck Protection Program, the Main Street Lending Program, and some of the tax benefits associated with that. Each of our panelists will be touching on each of those specific areas and touching on some of the practical aspects of what that involves and entails. So I'll turn it over at this point to Gladys Reed, who's going to walk us through the Paycheck Protection Program. Gladys.
Good morning, everyone. First of all, I want to thank Richard for inviting me to this important webinar for the Florida Bar, for putting this together. Not only am I a presenter, but I'm also a participant, and I look forward to listening to my other colleagues, panelists on this panel, because it's really a lot of great, important information, very fluid and timely. So as you all know, when the CARES Act came out, as Richard alluded to, and if you look up on the SBA Gov website, there's a lot of loans and resources, but the one that the bankers have been directly involved with is the Paycheck Protection Program loans, as we like to call the PPP loans. And so I'm just going to give a very high level overview. There's a lot of information on the website that I ask you all if you have any questions to go there, and I provide my contact information at the end. But let's start at the very beginning. It started on April 3rd, which now it seems like a gazillion years ago, when the application started to come in. And the program lasts till June 30th. The great news is there's still funds that are available, and I'll talk about that at the end as one of the main takeaways. The program started with the definition of what is considered a small business. In this particular program, the small business is defined up to 500 employees. So that's a pretty wide net. Or it could even exceed it if it meets the SBA industry size standard. There's a lot of eligible businesses. Some are ineligible, but the good news is most are eligible. And again, all of that is on the website where your banker can provide that information, including nonprofit organizations like the 501c3, 501c19, veterans organizations, or tribal business concern. I'm gonna go for the next slide. Okay, perfect. So what are the loans used for? Primarily, the intention of the loan is to cover the payroll cost of in order to allow these business owners to be able to maintain their payroll. And so specifically it covers payroll cost, and then it does allow for at least 25% on interest and mortgage obligations, everything incurred before February 15th. You'll see that this is a defining date, rent under lease agreements, and then utilities as well. And so what counts as payroll costs, right? So this is a question that comes up a lot. So the annualized salary for each employee is capped at $100,000, regardless of what that employer owner makes. By the way, this also covers independent contractors and sole proprietors. But the question comes up, could exceed $100,000 per employee? It can. What is considered non-cash benefits, right? So everything as is listed on the slide that talks about cost for vacation, healthcare, retirement. So all of that also could lead for more than $100,000 per employee. State and local taxes. We also talk a lot about business owners, but in fact, the program also allows for a lot of sole proprietors and independent contractors, again, with the same calculation capped at $100,000 salary. So I'm going to go to the next slide here. Okay, so how specifics about the loan. So the loans are capped, the maximum amount is $10 million. And the way the loans are calculated it's pretty easy. And again, the lender, the banker can work with the borrower in this calculation. So we look at the average monthly payroll of the business and multiply 2.5%. So let's say that the average monthly payroll for the borrower was $10,000 a month. The loan, in fact, would be 2.5, would be $25,000. So it's a pretty easy calculation, pretty easy application. And I'll talk a little bit about that in the next slide. The rate is at 1% if the loan is not forgiven. I don't want to go into the forgiven part because I know Richard's going to discuss that. Let's go into the next slide. So what happens, let's say, for example, there is an outstanding balance that is not forgiven. The payments of the loans will be deferred for 6 months. However, interest will accrue. The loan is for 2 years, as like the previous slide said, for 1%. I've been a banker all my life and I've never seen a loan at 1%. But of course, as Richard said, this is unprecedented and hopefully we'll never go through this again. But it is any outstanding balance would be for 2 years, totally amortization for 1%. Other important parts to this, there's no prepayment penalties, there's no fees, there's no personal guarantee, there's no collateral. And the next slide. So a couple of just high level things that I wanted to cover, which I thought was really just a huge overview, a big overview on the numbers, and I'm not going to go through any numbers. So as I mentioned, this is the second round. The first round, the funds went out in 16 days, and this is the second round of these loans. And so you'll just, like I said, I don't want to go through all of the numbers, but I thought it would be interesting to share with you all from the SBA, and these were the approvals through last Friday, how the size of the banks, the overall numbers, how they worked out. You'll notice the one thing that struck me is there's been a lot of question is the right businesses, is the small businesses getting their share of the funds? And nothing is perfect. Certainly this is not perfect. And again, this is all unprecedented for us. But if you notice the community banks, which is technically like my bank at Ocean Bank, under 10 billion in assets, the average loan amount, and I calculated this, was at $62,000 approximately. And so I really believe, and that's not surprising based a lot of community banks are going to bank more of those smaller businesses. But at the end of the day, all banks have really been contributing to this. So again, this is by state of the United States. Certainly, I'm not going to go through all that, but I wanted to highlight Florida. So Florida actually is number 2 with, thank you, Richard. He's been a great, oops, here we go. We'll go back a little bit to the other one, the previous one. Okay, perfect. Thank you. So I just wanted to highlight very quickly Florida. So Florida in the nation is number 2 in approved loans at over 222,000 in the second round. Number 4 in total approved dollars. Not surprising again, because obviously we're significant from a population standpoint, but I want to say our Florida, all the Florida bankings are really trying to work very hard for all of the business owners with this plan. And then I think the final slide in my presentation, and I'll have some concluding comments. So, perfect. So this just shows that, again, if we talk about just the loan size and approved loans on overall in the program, the one thing I wanted to highlight here is the average loan size is 73,000. If you remember my earlier comment, the community banks have been at average around 62,000. So we really feel that we're helping a lot of folks. And before I turn it back to Richard and the next panelist, I just want to say that a couple of main takeaways. Important for you all to know, there's still funding available. As of Monday, there was still 120 billion left. So there's still opportunities. Please reach out to your lender, your banker to help you. I can tell you my own bank, very proud of Ocean Bank. So far, we have done over 1,800 approved applications, 181 million, helped over 30,000 employees. And we are still, my team in fact has been working everything from the front end to verification to submission. But all of the banks are still very active with this, of course. And absolutely, we're there to help. There's still funding available. We want to help more business owners, and any information, or I should say, any questions you might have, I'm a resource. Please do not hesitate to call me or email me. And with that, I want to conclude my comments and Richard, hand it back to you.
Perfect. Thank you so much, Gladys. Appreciate the overview on the Paycheck Protection Program, a lot of the details that were provided there on what the program entails, what's covered, and how you go about securing those funds. And most importantly, that funds are still available. So for participants, whether you're a business, an attorney, an accountant, a professional, if you or your clients still have the opportunity to get that Paycheck Protection Program loan, please reach out to Gladys or your local bankers to do that. So my role and responsibility here on the panel will be to talk a little bit about the PPP forgiveness. That is obviously the more key or important feature of the loan itself, is that in the end, if you do things right, the loan will actually turn into more of a grant. And the question is, what is it that you need to do in order to secure that forgiveness and ensure that that is done? So it's all or any portion of up to 100% of the loan can be forgiven. The amounts that are forgiven are not treated as taxable income. So in other contexts, in commercial lending and other situations where you have a loan and that loan has been forgiven, you know, that can be treated as income on which you'll be taxed. But in this case, there's an exception, and that will not be the case. The important thing is to make sure that what you spend the actual loan proceeds on is on eligible costs, and that eligible cost expense be done within the 8-week period following your funding. So from the day you get your funding and the 8-week period thereafter, that is when you need to be spending that funding on the eligible costs. What are the eligible costs? Well, there's the payroll costs, which Gladys already went into quite a bit of detail on, but you'll see on this slide here that outlines some of those. Obviously, gross salary, wages, tips, unemployment taxes, employer payroll taxes, etc. One thing that's not included, which needs to be clarified, is fees or payments to independent contractors. The CARES Act provides specifically that the independent contractors should be securing those loans themselves directly and not through the contracting party. So if you're an employer that has employees and contractors, the contractors themselves have to secure their PPP directly, and then any expenses that you pay cannot be to pay those contractors, but rather your employees. Non-payroll costs that are covered are interest on mortgages, rent payments, utilities, and those are for all those obligations that arise on or before February 15th. So I need to really make sure that these are not new costs or expenses that have originated, but that they are from obligations that have taken place before that date. And as Gladys also alluded to, 75% must be of payroll costs, 25% non-payroll costs. Now it's important to make sure that it's clear that the 75% and 25% is of the eligible costs. So if you get a loan for $1 million, but your eligible costs are less than that, then your 25% that you can use for forgiveness has to be based on the amount of eligible costs, not the amount of your actual loan. So it's important to make sure that you factor that in when you're doing the calculation. Okay, so you have some forgiveness up to 100%, as I mentioned earlier, based on the criteria that I just described. However, there are reductions that need to be counted for. Those reductions are related to salary and wages, as well as workforce reduction. So remember, the focus and incentive around this entire program is to keep individuals employed. And so they want to make sure they do that by maintaining their salaries and maintaining their employment. If there is a decrease of more than 25% of any employee that makes less than $100,000, that is going to have a dollar for dollar reduction on the amount of forgivable loan that's contributed. So if you have someone that makes less than $100,000, you reduce their salary by more than 25%, let's say $74,000, then you have already a $1,000 dollar for dollar reduction, if you will. So it's really based on what percentage beyond the 25% reduction have you reduced wages overall for all your employees. And then doesn't mean you can't use the monies, doesn't mean that you have to return, you just have to repay it based on the terms that Gladys had mentioned earlier. That said, there is a way to restore all of it, and that is ensuring that all the salaries and wages are restored by June 30th. So if you have salaries and wages of $75,000, like I mentioned earlier, $74,000, and that is actually restored by June 30th and forward, then you will not be subject to the forgiveness reductions that I just described. On the workforce FTE reduction, an FTE is basically identified as anyone having a minimum of 30 hours of work per week. And if you have part-time employees, you can use a combination of that to identify an FTE. However, if you are reducing the workforce, and you have to basically do a formula that will be the lesser of the FTEs per month during the February 15th to 30th period, or the FTEs for the month of January 1st through February 29th. Whatever is lower can be used in the formula to determine exactly what that reduction will be. Now there's an entire sort of calculation, and I won't get into the details of that, but the important thing to note is if in fact there has been a reduction in workforce, you need to work closely with your accountant or attorney to determine what calculation will be affected and how that will impact the forgiveness of the loan that you've done. Several worksheets that I've done and spreadsheets that I've worked through with my clients on calculating the best scenario and which of those two options is better. And then the other thing again is to ensure that if you have by June 30th restored the full FTE, whether it's the individual employees that you had before or someone else to substitute, you can go ahead and avoid the workforce reduction on the forgiveness. The one other thing that I think is important to note is that if you have employees that have been laid off or furloughed, you can bring them back and offer them that work, a return to work and rehire. And if they reject it, then those folks will not be calculated into your workforce reduction adjustment. So you need to make sure that you document that, and I'll get into that a little bit later, but you can offer them the job back, give them the actual salary and wages that you're going to restore them at. And if they reject that offer and don't accept it, then that would not go against your reduction calculation. Okay, other considerations on the PPP forgiveness, no deductions for business expenses. So business expenses that would generally be covered as a deduction, like your rent or utility or other things of that nature. If you're using forgiven proceeds, loan proceeds that have been forgiven to pay for those cannot be deducted from your income tax. So that's something to think about as you sort of pick and choose what type of expenses you're going to be applying those proceeds for. That may be non-payroll expenses. Second consideration is documentation. There is basically a formal loan forgiveness application that will be required. You will be required to certify that you've used the proceeds for eligible costs. You need to maintain adequate books and records with respect to those costs to ensure that if there is an audit, you have that covered. And you also have to have copies of mortgage statements, leases, other payroll records, et cetera, that will be submitted. It's also important to note that there is no forgiveness guarantee. It'll be up to the discretion of each individual bank to determine whether the criteria has been met, and even if it has been met, whether it will provide the forgiveness or not. So it's very important to make sure that you have a continuous dialogue and discussion with your accountant, with your banker, and your attorney to evaluate and assess on a go-forward basis that the forgiveness is aligned and that the certification can be made that the proceeds have been used appropriately. So I can't emphasize that enough. That has been really at the heart of ensuring the forgiveness is there, using the proceeds appropriately, but also documenting that it's been done as well. Some frequently asked questions, and I won't go through all of these, but basically the affiliation rules determining as to whether a minority shareholder that controls a business would be affiliated. If they give up or relinquish those rights of the minority shareholder, they can be removed. And so they're not coupled with the calculation on whether or not the employer satisfies the 500 threshold that Gladys mentioned earlier. Quick point on that. Do PPP loans cover sick leave? Yes, sick leave is covered. However, many of you also probably are familiar with the Families First Coronavirus Response Act, where there are some credits that are being applied. So you can't double dip. You either use it for one or the other. And if you've taken the Response Act credit, you cannot then get credit for it on the PPP side. How do the $10 million cap rules apply to franchisees? There's a specific list of franchisees that have been provided by the SBA. You can look on their website, and in some cases, those cap limits may be flexible depending on the actual franchisee and only apply to the franchisor. So look into that as well for more guidance. Do businesses owned by large companies with adequate sources of liquidity get the opportunity to qualify for the PPP loan? This has been an area of much debate. In fact, yesterday there was a new guidance that was issued by the SBA on this point because there's been some back and forth. And rather than address it here, I'll just address it in this next slide, which is, should you return your PPP loan? You may have seen in the news both AutoNation, Shake Shack, Ruth's Chris, and many other large companies returning PPP money. Some of it as a result of maybe not technically satisfying the requirements of the PPP program, but others also for public scrutiny and public relations issues. So those need to be adequately addressed and thought through both individually for your companies as well as perhaps your clients. But the two things that need to be evaluated are both need. Did you need the money at the time that you requested it? And 2, sources of liquidity. Do you have the sources of liquidity to satisfy the operations required during this pandemic without the need of the PPP loan? That is a very fact-specific and case-by-case analysis. I urge you to discuss that very closely and specifically with your accountants and advisors, attorneys, to evaluate that. But I can tell you that yesterday, just yesterday, a safe harbor clarification came out that to the extent the loans are less than $2 million, if you or your clients have received less than $2 million, you should expect that there will be a presumption that there was necessity and good faith, and that the sources of liquidity are not adequate and therefore should be satisfactory. For those loans that are more than $2 million or more, there is no presumption, but that doesn't mean that you can't ultimately justify, for example, hospitality industries and other industries of that nature, that you have the necessity and that you do not have the adequate sources of other liquidity and capital. So be evaluating that directly, make sure that it's done, and honestly, be sure that it's done like today. I know it's very short notice, but as you see, the actual deadline for the safe harbor that's been given is at the end of the day, May 14th. So I would urge you to really focus on that. If you've received or your clients have received a loan in excess of $2 million, that you do a quick and important analysis on that. One thing that's important is also the scrutiny that's being provided by the SBA. They have said that that they will not be referring this for prosecution provided that the loan is paid off. So that alleviated some concerns there, but it's still subject to audit, and there's a statute of limitations of up to 10 years. So again, it's important to verify that you're eligible, that the need is there. The understanding is that the expectation is that if the loan is under 2 million, it's fine, you have that, but anything over 2 million, you need to provide a little bit more scrutiny to ensure you get comfortable. And at the end of the day, confirm that you have the documentation necessary to establish what the proceeds were used for and how they were used. With that, I will turn it over to my good friend and colleague, Jose Sarriego, to talk a little bit about the Main Street Lending Program. Jose.
Thank you, Richard, and good afternoon, everyone. You're probably wondering who this hairy fellow is who's appearing on your screen, standing in for that clean-shaven Sarriego. It is indeed me, but I have vowed not to cut my hair or shave my beard until the Fed actually launches the Main Street Lending Program, or the bars reopen, whichever occurs first. And I am betting on the bars. And that's a good segue into some of the differences between the Main Street Lending Program and the PPP. First of all, it hasn't been launched yet. So while billions of dollars have gone out under these other programs, not a single nickel has been spent or loaned under this program yet. But not to worry, because even though there's a deadline of September 30, when the program technically terminates, there is no specific appropriation for this particular program like there was with the PPP. So if the program takes off and they need to extend the deadline, they can. And if they need more money, then Jerry would just call his buddy Steve over at Treasury and say, Steve, I need more money, go down to the mint and print some more for me. And they will make it available. So that is helpful because there are still a lot of questions about this program, and it remains to be seen what the documentation is going to look like. There's not even a loan application yet, and there's other details that still need to be worked out. But at least the term sheets are out. So what are some of the other differences? Well, a very important difference. You're going to have to pay this back. Unlike the PPP programs and the loans under that program, none of these are forgivable. So you're going to have to pay them back. And we're going to talk later about the amortization. You know, it's relatively short, 4 years. So, you know, make plans for that. Secondly, because as we'll see, the lenders have to retain a significant portion of these loans. Lenders are expected to perform credit analyses and underwriting just like a regular commercial loan. And not only that, but they can apply their own criteria, their own documentation. And so, you know, you need to find a bank that either hopefully you have a good relationship with or that is going to meet your needs. Lenders are not obligated to lend the maximum amount. So even if you qualify for $20 million, they can lend you less. They can also require collateral, including personal guarantees. So you have to be aware of that as well, something that's different from the PPP. And the term sheets that we go over and that the Fed has published are minimum. So there can be more than what's required there, again, on an individual basis. But the good news is that you can participate in the Main Street Lending Program, even if you receive money under the PPP. However, as we'll see later, you can't participate in more than one of the 3 facilities under the Main Street Lending Program. Richard, next slide. So, so who can apply for these loans? First of all, the overall is similar to the PPP in that you need to have this money, or the need for this money has to be to fund ongoing operations and to maintain payroll. So you need to have that as an overall need or an overall scope for this program. But it is available basically to just about any US business that has not more than 15,000 employees and not more or not more than 5 billion in 2019 revenue. And that's calculated together with affiliates, which is very important because the SBA affiliation rules apply, and those, as many of you have found out, are rather broad in defining what an affiliate is. It also has to have been created or organized in the US before March 13th, 2020. It has to have significant operations in the US, which is not really defined, but you have to assume that probably a majority of your operations are in the US. Certainly a majority of your employees have to be in the US. That's a requirement. And one unusual part of this program is that you had to have been in sound financial condition prior to the pandemic. So as we'll see, some of the requirements for calculating the maximum loan size favor companies that were not in trouble, that had good cash flow, did not have a lot of leverage. And, no offense, Gladys, but sometimes it seems like banks give you money when you don't need it. You can have foreign ownership of the US business, but curiously, in the case of a joint venture, it can't exceed 49%. And right now, nonprofits are not eligible borrowers because basically EBITDA does not work well for establishing the credit risk of those types of entities. But the Fed said it's evaluating a separate program. Next slide. So how's it going to work? The Fed's going to create a special purpose vehicle. Actually, it's the Federal Reserve Bank of Boston that's going to do all this for all the federal districts. And it's going to purchase loans that are originated by your local lender after April 24, 2020. The SPB, depending on the facility, will purchase up to 85% in the case of the priority loan facility and 95% in the case of the other two, which means, again, that the lender is going to have to retain either 5 or 15% of the loan until maturity or until the SPB sells its participation. So that's why you're going to go through the root canal of underwriting on these types of loans. So I mentioned there's 3 facilities, the new loan facility and the priority loan facility, which are for new loans that can go up to 25 million, although again, the maximum loan size could be much less than that. And then the extended loan facility, which is if you have a loan, you can now upsize it up to $200 million. But you can only participate in one of the facilities, as I mentioned before. So here are the loan terms. I think most of you are familiar with them, so I'm not going to spend too much time on them. You do have a principal and interest deferral for a year. But as I said, you have a 4-year maturity, and 4 years goes by very quickly. The rate is LIBOR plus 300 basis points, not too bad. It'll be curious to see what happens with LIBOR when it's no longer being used in the future. But the Fed is looking at that. Originally, it was a SOFR rate. But they decided to go with LIBOR after receiving a lot of comments from bankers. As I mentioned before, it could be secured or unsecured. You can prepay it without penalty. And then the various loan sizes are, it's a minimum of 500,000 for the new and the priority facilities and up to 25 million, as I mentioned, and then a minimum of 10 million or up to $200 million for the expanded facility. Richard? All right, so how do you calculate the maximum? Well, there's a cap of 25 million in the case of the first two facilities and 200 million in the other, but it could be less than that because you have to calculate in the first two cases the EBITDA of the borrower, which can be an adjusted EBITDA, an interesting concept, which we'll talk about later. But then you have to deduct all outstanding and committed but undrawn debt from that EBITDA number. And that will give you the maximum loan size up to the caps that we talked about. And then with the expanded loan, you have a third formula, which is 35% of your outstanding and committed but undrawn debt, in addition to the EBITDA calculation and the overall cap. And if you have a loan that you're upsizing, then that loan must have at least 18 months remaining to maturity. Although if it has less than 18 months, you can actually extend it for 18 months if you want to and if the lender agrees. Next. Okay, so what does outstanding and committed but undrawn available debt mean? Well, basically it's all amounts that you've borrowed under any loan facility, under publicly issued bonds, under private placement. It's unclear if it includes PPP loans. That's something that hasn't been clarified. Although I would argue that it probably does, because again, this facility or this program is intended to provide additional on top of what you already have available if you meet these tests. So if you already have a PPP loan for $10 million, not sure why it would not count, but that's unclear. Unused commitments under any loan facility are also included because again, the lending program, the Main Street lending program is supposed to be a loan of last resort, so to speak. And then there are some exceptions to that, which you see here. Then with respect to adjusted 2019 EBITDA, it has to be the same methodology that was previously used by the eligible lender with respect to that borrower, or that lender has been using with similarly situated borrowers. So you can't monkey around with it too much. You're going to have to justify the adjustments if indeed you're going to make something radically different. Next slide. All right, so amortization, as I mentioned, it's a 4-year term in the new facility after the first year, because the first year is deferred, although it does accrue. Interest does accrue during that first year, but you'll be paying it off on straight line amortization of a third each year. The other two facilities after the first year amortize a little more slowly, 15% and 15%, but then there's a big bullet at maturity of 70%. So again, keep in mind that at the end, you're going to have to either refinance this or pay it back. Now, there are some rules about subordination of the loan. And there's a difference between the facilities. The new loan facility, it says that it can't be contractually subordinated to other loans or debt instruments. So you can't specifically say in the loan that it's going to be subordinate to any other loan, but it doesn't prevent you from doing a number of things which are set forth in this slide and are outlined in the FAQ from the Fed, which I commend to all of you because it's that provides a lot of detail on some of these questions that have not been answered. Next slide. So, and then on the priority loan facility and the expanded loan facility, it specifically has to be senior to or pari passu with other loans or debt instruments other than mortgage debt. So if you have mortgage debt, that can be senior, but everything else has to be either equal or junior to the Main Street Lending Program loan. And then you also cannot cancel or reduce any existing committed lines of credit that are outstanding, except in an event of default. Again, that's because of the idea that these loans are a supplement for your existing credit. Next. All right, you're going to be paying some fees, not surprising. By the way, eligible lenders is limited to bank institutions. And originally it was only US banks, but now branches or agencies of foreign banks and US holding companies of foreign banking organizations are also eligible lenders. But what are not eligible lenders are non-bank financial institutions, although the Fed is studying that to see whether it will have additional lenders for this program. There's a facility fee that the eligible lender pays to the SPV, which depends on the facility. It can be 100 basis points in the case of new and priority, and 75 basis points in the case of the expanded. And the lender may, but doesn't have to, pass on this fee to the borrower. And then there's an origination fee of, again, 100 basis points in the case of new and priority, and 75 basis points in the case of the expanded, which the lender can charge. And again, although it doesn't say so, I mean, the lender doesn't have to charge these fees. It can charge less if you have a good banking relationship or if you're otherwise a good credit for the bank. There's also a servicing fee, which the SPV will pay the eligible, the SPV will pay the eligible lender as a servicing fee, and the borrower is not responsible for this fee, but it's something for the bankers to compensate them for the time and effort that they're going to spend keeping track of this loan. Next. Now, there are a number of strings attached to this that apply either in this particular case or apply to all the loans under the Title IV of the CARES Act. Under this particular loan, the eligible borrower has to make good faith, commercially reasonable efforts to maintain payroll or retain employees. Now, unlike the PPP, which has very detailed requirements as to who you pay and who you can't pay and this sort of thing, this is really undefined. And the FAQ has a little bit more guidance on it, but as you can see, it's a much looser standard. But at the same time, again, the loan has to be used for that type of purpose, for maintaining operations and for maintaining payroll. So there is this commitment that the eligible borrower has to make. And then the eligible borrower also is subject to requirements that are applicable to all direct loans under Title IV of the CARES Act. And those are restrictions on what you can do with the proceeds, and also limits on compensation. So here you've got limits on payment to purchase equity securities of the eligible borrower or its parent that are listed on a national exchange. They don't want you using this loan money, to buy back stock, and they don't want you paying dividends or making other capital distributions to the owners of the businesses either. Although for this particular program, they carved out an exception for sub-S and other pass-through entities that can make distributions to cover taxes. Now, the important thing to note about this in the next slide is that this is 12 months after the loan is no longer outstanding. So you're going to be stuck with these limitations for a period of time. Even if you prepay it early, you're still stuck with it for a year after the loan is no longer outstanding. And then these are the officer and employee compensation limits, which I'm sure are of great interest to this audience, because all of you exceed $425,000 in compensation or make over $3 million. So you will be limited in what you can pay these highly compensated individuals, again, for a year after the loan is no longer outstanding. And these requirements have been given a lot of publicity in other contexts. And some borrowers are having second thoughts about this, depending on their size and their compensation levels, because of the, it's a serious limitation on what they can pay their employees. Next. Okay, so here are some questions that have come up as we've been talking to clients and to the banks and all that. The main one is, can you refinance existing debt? In other words, can you prepay that debt? Now, you can use the proceeds, or money is fungible, but you can pay existing debt as it matures. So if you have quarterly payments or a bullet or whatever it may be, you can make those payments. But what you can't do is prepay when you're not otherwise wouldn't otherwise prepay the loan, except that under the priority loan facility, you can use the money to refinance existing debt with a lender that is not the eligible lender that's making the loan. So you can pay debt of a different lender if you have that kind of debt outstanding, but only under the priority loan facility, which has a more a higher leverage tolerance than the new loan facility. Now, we mentioned before that that this is not a program for highly leveraged companies. It's also not a program that could easily fit companies who don't have a lot of earnings and EBITDA, or more asset-based companies where they're more of a balance sheet type company, and that affects a lot of real estate companies, obviously. But the Fed said that it is looking at alternative methodologies to come up for these other types of companies that may have trouble meeting these EBITDA targets. And as I said before, it can be quote adjusted based on previously used methodologies that the lender is using for either that borrower or for other similarly situated borrowers. We talked about the commercially reasonable efforts. You have to exercise good faith efforts to maintain payroll and maintain employees in light of your capacities, the economic environment. A lot of kind of generalities here. But one important thing is that even if you've already laid off or furloughed workers as a result of the COVID-19 crisis, you're still eligible to apply for these loans. Next. Do eligible borrowers automatically qualify for an eligible loan? No, again, the lender has a lot of discretion here. They can conduct an assessment of the borrower's financial condition at the time of application, apply their own underwriting standards, require additional information and documentation. The Fed is going to require certain minimum standards, which they haven't come out with yet, but they will. But the lender, again, can impose additional ones on top of that. And then I think this is the last question, which is, how do you calculate this 2019 revenue for the $5 billion limit? Again, you have to include affiliates, but revenue is either going to be based on your 2019 GAAP audited financial statements, or if that's not available, then you can use the prior year, 2018, or you can use your annual receipts for 2019 as reported to the Internal Revenue Service on your tax returns. Next.
Great, thank you, Jose, for that review of the Main Street Lending Program and the insights provided there as well. Appreciate you going through that. At this point, we're going to turn it over to Josh Schultz, who's going to talk through some of the CARES Act business tax benefits and provide us with some clarity on where, in addition to the lending program, benefits that we've just reviewed, where are some of the other nuances and benefits that the CARES Act provides. Josh?
Thanks, Richard. And I'm going to get through this quick because we've been getting a lot of questions and I want to save some time for that. But just so everyone's aware of how much is changing, I literally was on scrolling through my phone and I got an update from the Journal of Accountancy. The safe harbor date now is not the 14th. It's been pushed back to May 18th. And another very important thing, really a correction, is for partnerships. And I know a lot of attorneys are formed as partnerships. The calculation for partnerships basically excluded those partners' compensation. So the guidance now that came out through the SBA is that you can go back to your lender, include that compensation, still up to that 100K limit, and ask for additional funds. So the only known thing that we know is things are going to change. But let's talk about the business tax benefits. Not a lot on there. Everyone's been very focused on the liquidity aspects of it. But just so everyone knows, I pulled some stats. 47% of the tax aspects are related to business, and that equates to about $276 billion is what the projections are. And a lot of what these business tax benefits are doing is they are loosening several of the restrictions that came in through the Tax Cuts and Jobs Act. The two very important ones that I think are going to be helpful, they're going to boost business, and they may not boost business investments, but they are going to improve cash flows, is the net operating loss carryovers and the interest expense limitations. For net operating loss carryover, if you have those losses, they're no longer subject to that 80% taxable income limitation. And you're able to pull those back for 5 years. That's very important because if you remember, the corporate tax rates were hovering around 34, 35% for the stated rates before they moved down to the 21%. So for those prior years, there's an opportunity in those high tax years to reduce that taxable income for corporations. On the interest expense side, they increased that to 50%. And you can use your 2019 adjustable tax income for purposes of that 2020 calculation. So they're increasing the expense limitations on that, and they're allowing for the loss carryovers to go back 5 years. That's the most important part of that. The AMT credits, the AMT, for those of you who don't know, it's an alternate tax. They're allowing now for those credit amounts to become refundable through to 18 through 21. The CARES Act actually accelerates the refund schedule, permitting corporate taxpayers to claim the refund in full in either 18 or 19. And if you want to do that, Form 1139 is how you do that. Richard, next slide, please. Payroll tax payments. So as an employer, you are allowed to defer your payroll taxes on that 6.2%. However, you will still be responsible for 50% of that by 2021, and then the remainder by 2022. So this is just a deferral. It's a way to maneuver cash flow in this point in time. The employee retention credit has gotten a lot of talk. The main change on that is before the tax credit was up to $10,000 per eligible employee. That is now moved to $5,000. One important thing that I want to note on the employee retention credit is you cannot get this credit if you have forgivable loans on there. And I think that's an important thing for everyone to understand. Next slide, please, Richard. Oh, go back here real quick. Sorry about that. The employee paid leave. So if you have an employee who believes that they were sick or they had a family member, there's a dollar for dollar tax offset against your payroll taxes. In the aggregate, that works out to about $5,110. That's 511 times 10 days. Basically, what that's going to do is if you covered an employee who fell to COVID, you're going to be able to get that credit. And that also works with children or someone that you're giving, excuse me, direct child care to. Now, something that is getting a lot of attention is the forgiven expenses related to a PPP loan are non-deductible as they sit. The IRS sent out that guidance. If you think about it, it makes sense. They're not asking you to claim it for income, thus there's no expenses to offset that. That being said, the AICPA is working with some other groups across the country to change this. I struggle with that change. I think it's fairly, I think it's a fair way to handle this. What we are talking about, though, is from a tax planning strategy. In addition to those credits that we talked about, the net operating loss carryover and the interest expense limitation, that's going to free up some cash flow potentially, right? The other point, though, that I want to bring is during this covered period, if you meet that goal of getting the loan forgiveness, and yes, maybe revenues did fall, but you have to remember your overhead, and for most of us on here in the service industry, which is a large part of what the country is working on now, the majority of our overhead is going to be taken care of. So even if you had a 25 or 50% reduction in revenues, you have to remember you're not going to have an offset against that revenue. So what is that going to do to you from the tax standpoint? And those are all things that need to go into the future looking forecast. Now, a lot of these net operating loss, interest expenses, the benefit is really going to be for those individuals that have a household of over $1 million. And this is all coming from the Tax Policy Center because they're allowing the offset of these active losses against other forms of income. So if you have multiple entities or real estate or holding entities, these are the clients or the individuals that really need to be concerned about this, as well as at the corporate level, in my opinion. The other thing that they did is they stopped the business loss deduction cap was suspended. This was a big thing for those high income households. They're suspending that. All of this, right, equates to a lot of money. And from a tax planning strategy, when you're sitting down with your CPA, your tax attorney, you need to be understanding all this. There's also opportunities in the gift and estate tax arena right now because of devaluations in assets. My biggest concern is, okay, how is this going to affect companies that only had a 25% offset, right? I think the interest expense and NOLs are very good things. The credits are very good things, although you get knocked out if you receive those forgivable loans. So putting in those forecasts and knowing how you're going to look at this come November, December with your CPA or whoever is your preparer is extremely important. Also, just reading through the tea leaves, we don't understand how a lot of these programs are going to be paid. There's several organizations that are already believing that depending on how the elections occur this year, we will see an increase in tax rates. Probably not at the individual level. I do think that the potential risk lies at the corporate level, but none of that has been seen, and that's all conjecture. Went through that fast because I wanted to leave some time. We have like 20, 25 questions. This is very straightforward stuff. The slides will be made available. With that said, I'm going to hand it over to you, Richard, so we can get some of those important questions answered.
Perfect. Thank you, Josh. Appreciate you reviewing that. Let's get then to the Main Street Cares Roundup, a little Q&A session here to cover some of the questions that have been brought up by the audience. We only have about 4 minutes or so, but we'll try and get through as many as we can and cover them accordingly. So first question, can PPP proceeds be used for payroll taxes? And if so, all or which parts? My understanding is yes, they can be used for payroll. In terms of which parts, Josh, you're asking about the specifics here, obviously on Social Security, FICA.
Yeah, the employer side is not covered in that. Okay, so it's on the employee side, but the employer side is not covered by that.
Okay, gotcha. All right, next question here that we've got up. Let's see. If we don't have enough forgivable expenses in the 8 weeks, can we spend our money on any capital A-N-Y business expense or just on the payroll covered expenses, rent, utilities? So you got to spend it within the 8 weeks to get the forgiveness. You got to spend it in that 75-25 breakdown between payroll and non-payroll to get the forgiveness. If you keep it and you haven't spent through all of that by that time, you can use it, but it has to be for eligible costs because that is a certification that you used at the time that you draw the loan, and then you'll just be responsible for repaying that.
Richard, if I
Go
may
ahead.
interject.
Yeah, Josh, if anybody wants to, go ahead.
Yeah, so this question has come up. I'm very curious on how people calculated some of these things, and I do see a windfall in that. If you want forgiveness, right, you have to follow that 75-25. Otherwise, it becomes a loan with that 1% interest rate. Is there an opportunity to swap out bad debt with this much more favorable debt? No one has said no against that yet. Do I think we're going to hear more about that as we get into the June, July period? Probably. I think a lot of it is going to be based upon the liquidity that is coming from Treasury. But at this point in time, if you don't get forgiveness, then you basically have that excess at 1% for a 2-year period. So when you look at your credit card rates, that's a choice.
Okay, next question. Can owners give themselves or their employees a raise or bonus during the 8-week period and have that forgiven? Very popular question. I think it's a gray area. There hasn't been full guidance there. My recommendation has always been to the clients, use as much of the actual payroll as you can. Try and avoid the bonuses. And then raises, I think in some cases we've been able to talk through the clients to justify if there's additional responsibilities. For example, if not everybody comes back and they're doing more roles or responsibilities if necessary, but again, trying to do that as a last resort. Bonuses, my general suggestions or recommendations been no, but Josh, I don't know if you have a particular take on that or where you guys have seen that go.
I would advise against it. I think if the raises are in line with historical patterns, right, that's something to consider. But let's all remember the intent behind this. I do see situations where people had a calculation and they find this excess. Bonuses, definitely not. Commissions, I would be very careful with that and make sure that I had historical records to show that that was in line. But they're very straightforward on wages and salaries. If you have an employee that was at a $75,000 level, and the next thing you know, you want to bonus them out to take up the rest of that, to me, I put on my audit hat, that's a red flag. And I know that businesses under the 2 million are not going to qualify for that must-have audit, if you will, for lack of a better term. But I do believe that there will be resources looking into this. So I would just play it very, very careful with that.
Richard.
Yes, go ahead, guys.
I just wanted to mention, because there's a lot of great questions. I tried to answer a couple of them very quickly. They're very popular, and I just wanted to mention them for everyone that's participating. Great participation, by the way. Independent contractors need to apply on their own. That question gets asked a lot. The safe harbor, just this morning, somebody put in the chat, and they're correct, got extended to May 18th. So this is the second extension of that, which is good. They're giving us more time. The other thing too that comes up a lot are K1s. Those are not, dividends are not part of the plan. So I just wanted to cover those three that I saw that are a lot of popular questions, and there are a lot of really good questions. So I wanted to mention that.
Great, thanks for bringing
And
those up.
speaking about the independent contractors, because we've handled this within my firm quite a bit, is for independent contractors, if you pay yourself a salary, that's included in your calculation. You can also add on your line 31. And if you think about it, what the government is saying is, look, you avoided self-employment tax for many years. We're not going to let you take advantage of it now. So you have to take what did you claim for salary on your Schedule C, and then you can add in your line 31, which is your net profit that gets taxed at those federal rates.
Okay. What's included in transportation? Guidance on that, Josh? I mean, I've seen anything from sort of bus passes and those kinds of things, but maybe some questions around whether that includes auto leasing.
So I didn't know transportation was a non-payroll cost. To be honest with you, I saw that question.
Okay. Yeah, it's reflected, but I haven't seen any guidance to really specifically speak to what that incorporates or what it entails.
Yeah, so I look at the IRS and how the IRS defines things, whether it's an employee and whether it's a utilities. And utilities has been asked a lot, what's included in that? And I think you're going to handle that. But transportation, I haven't heard of that as a non-payroll cost that's covered under the PPP.
Okay. Let's see what else. We got about two more. What is included in utilities, telephone, internet, Westlaw research for law firms? What else? Certainly electricity, telephone, cell phone, computer access or Wi-Fi. I have not the internet. I have not seen any Westlaw or Lexis research covered in utilities. So I'm not, I haven't seen any clarity on that. And that's pretty much it. Some gas, if you're on gas and things of that nature. Josh, anything else you've seen under utilities?
No, you hit right on that. I think the one, to your point, is electricity, gas, what we commonly think. Internet charges, I believe the IRS is, I'm not 100, but I know phone is covered in there.
Yeah, cell phone. Okay, there's a question also under the Main Street Lending Program. I think we'll turn that one over to Jose. Jose, can you pick up on that one? I think you're on mute. You're on mute. Sorry.
Sorry about that. The only one I see is why was LIBOR used rather than prime? The only thing I can say is it was going to be SOFR. And I think LIBOR is just the more commonly used rate by banks. The problem with LIBOR is, of course, it's not going to be used very next year. In fact, it's starting to phase out. But if they don't use LIBOR, they're going to go to SOFR. I don't think they're going to use prime because it's simply not as well accepted by the bank.
Okay, perfect. Well, that's about all the time we have. I know there's still a few other questions that came up, and I'm sorry we couldn't get to them all, but want to be respectful of everybody's time as well. Hope you enjoyed our program, Main Street Cares. Thank you to our panelists, Gladys, Jose, Josh. Thank you to the Florida Bar, Stephanie and Tracy, and also to the Business Law section for hosting this CLE series. I think it's been a great series that we've put together for all of our members. If you folks have other questions or comments, please look at the actual presentation. It will be available to everyone on our website on the Business Law section, as well as being sent to you via email if you registered. So you'll be getting our final deck with our contact information as well. I think that's pretty much it. So thank you, everybody. Stephanie, do we turn it back over to you for closing remarks to let us go?
Fantastic. Yes, thank you all for being here. As Richard mentioned, this will be available on our website if you want to view it again, if there's anything that you want to review as far as the questions that were answered. That will all be available on the website. Give us about 24 hours for that to be posted. And as far as the slides, they will be sent to you via email as long as you had registered for this event. So if you need anything else, please do not hesitate to contact me directly or any of our panelists. I know that they all provided their information for specific questions. So thank you all and have a wonderful rest of your day.
Great. Thank you, everyone. Bye-bye now.